Ladies and gentlemen of the crypto space, we're live on a Friday, December 1st at 11:34 a.m. From the ashes is where my mind is at, and I want to explain the way I see crypto markets compared to traditional finance, and I want to try my best to avoid what's going on in traditional finance because that's an entire story unto itself. Crypto markets, I've defined for a while now as an emerging market, just as you would have any sovereign nation around the planet. Why? This was not the case pre 2020. This was not the case in 2019. This was not the case in 2018, 17, 16, 15, all the way back to the beginning. Post 2020, we have this concept of really stablecoins taking shape as something that makes sense. Back in 2017, stablecoins didn't make sense. The concept of a crypto dollar is like, what the fuck? Everyone was investing in Bitcoin and figuring out what the hell ICOs were and Ethereum and trading, the concept of capital gains, appreciation, so on and so forth. But what the hell are you going to buy a dollar for? That didn't make any sense. But post 2020, all that changes. All that changed significantly. And now we have this whole narrative we've started discussing for all these years at this point on our stream. The concept of an emerging market by looking at these crypto markets as if they were a sovereign nation, and then he could clearly establish or identify the distinction between this emerging market and that of a traditional country. There's no land mass, there's no human population, although there's human actors. It's not like there's a centralized government, no central bank, but there's clearly stuff like Swift or whatever the hell remittance software is available, and those are called on and off ramps. Not software, but rails, banking rails, capital rails. So you can get capital in and out in a variety of different ways at this point, especially as compared to 2020. The capacity to move capital in and out of how many networks at this point is at a whole nother level. So that's exogenous capital. That's akin to, a bank in New York sending X amount of billions of dollars to a bank in Brazil. Banking rails transferring capital. Now, exogenous capital is only a part of what makes an economy an economy. You also have endogenous capital, and that's when people inspect like USM2, that's really endogenous capital within the domestic United States, the domestic banking system. But that's only a small part, yet again, of the total composition of an economy. You have private markets, you have non banks, you have all this credit, and that is the biggest component of the money supply. So that's what makes these crypto markets so different now. It's an emerging market, has exogenous inflows of capital, and it has endogenous money creation systems. And these systems now, as compared to 2020, are established. They are quite entrenched, and they have shown lindiness. Why? From the ashes. This market has gone through a business cycle. This is the first business cycle of these crypto markets. There was no emerging market pre-2020, as I said. 16 and 17 bull market wasn't an emerging market. It was, I don't even know how to define it. It was a speculative frenzy. It was just an asset. There was no higher level narrative to encapsulate everything that's going on into something that can be understood from a meat space perspective. So in the real world, in meat space, historically there is this concept called the business cycle, but it gets complicated because I wouldn't even define what has occurred since 87, and in some regards they did a lot of intervention all the way back to 29 and the Great Depression. So was there ever a real business cycle in the 1900s? Maybe 1919, it was argued that the silent depression was more hands off and more of an organic rising from the ashes. So probably that can be argued. I'm no historic scholar by any means, more like a vague narrative observer. That was probably the closest traditional finance has gotten to a real full business cycle. And that entails when things start to deflate, there's nothing done except when bottoms form, when capital starts flowing back into a market from external sources, you know, exogenous sources, and um, and that is a fascinating observation, particularly because uh, it has gotten more perverse and perverse over time. There's no way 2020 can be argued was even remotely an organic resolution to the business cycle. And clearly in 2008, there was full-blown intervention to a fractional size as compared to 2020. And that is the trend, obviously. More and more capital is needed to disrupt the business cycle and allow a premature stabilization of the components that contribute to a functioning economy. Now back to crypto. You have the whole capacity to inspect foreign nations, foreign emerging markets, real meat space emerging markets, and how they do economics, but we don't need to necessarily do that. What we can say with clarity and confidence is that if we define this space as an emerging market with no central bank, no central actor that has a capacity to intervene, 2022 was a full on business cycle in this emerging market. It was a complete wipe the slate clean of anything that had malstructured debt, was a non-systemically important piece of software, which is an enterprise in this emerging market. It was a clean the slate. It was a carpet bombing of the space, everything that happened in 22. So that's why the title of the stream is Rising from the Ashes, because now we start to see some interesting things going on that indicate bottoming. It's at the point where that is confidently statable. Bottoming is occurring. Now, clearly, you get the bigger narrative in play of what Mike Howell and Luke Raoul talk about bottoming, and from a liquidity perspective at the end of 22. Sure, great. There's the early from that perspective, but that's liquidity, and liquidity has to flow through channels and go through a variety of knock-ons to start precipitating activity throughout the emerging market. So liquidity stabilizes, and as I've said with regard to like the bond market, once things stabilize and volatility dies down, it takes a period of time before capital starts to make choices rationally. It's mostly irrational choices that are made when there's excess volatility, and that's literally the definition of what 2022 was. But now, a year later, after liquidity stabilized, we're starting to see rational allocations of capital to infrastructure, enterprise that has systemic significance. And we see that in chart patterns as they start to bottom. This is a concentrator, an Aladdin product. But this is my interest. This is a chart pattern that is seen everywhere, pretty much in the crypto markets right about now. This is maybe, every chart pattern will be unique, but I find this one very interesting, particularly because it's just almost an Adam and Eve, but this is an inverse head and shoulders. This is just a remarkable chart pattern. And this is a bottoming indicator. Clearly a reversal pattern, inverse head and shoulders, but you see this chart everywhere. So I'm not highlighting this other than for the fact that it caught my attention as something that has unique characteristics amongst the entire crypto space, from a market cap, fully diluted value perspective, as well as total amount of deposits compared to the market cap is absolutely ridiculous. And complete business cycle. This thing was completely liquidated. Irrational exuberance, complete liquidation all the way down, forced selling all the way down. And what I love about this chart is this pop here in June. Because if liquidity bottomed in Q4 2022, it encourages folks to start to think about rationally allocating capital. And then this is that. A group of actors, somewhat of a minor consensus, decided to allocate capital. But the trend is coming down. So this was treated as exit liquidity. Oh, I could get out of my position. I could finally get out of my position. It's all the way down at the bottom, and if I could only go up 50%, I could get out. I'll never touch crypto again. And they got out. And it kept selling. It never got below the previous low, which is like something we observe with Curve. And frankly, this is something we observe across the entire space. This is a complete reset. Complete reset. Rally, higher low, higher low, higher high, dip. I mean, and you see that the frequency starts to get closer and closer. It takes less time for some actor that has enough capital to move the market to step in. And what's interesting, it's a $1.5 million asset. You don't see this in something that has this, it's a relatively short history. It's about a year. But you don't see this. This is just a remarkable setup. And you guys know I don't allocate capital lightly. I'm quite intrigued by this. Now, there's complexities with it, particularly because overall macro conditions do indicate we could have still a variety of liquidity disruptors. There's plenty of reason this falls down significantly, and when you have such a microcap asset, there's no reason it can't fall to 50, 40, or just retest bottoms again. But this indicates something. It tells us something that actors are starting to rationally allocate after all of this depreciation, which is quite fascinating. And this is going on across the market. The gold market says something is going on. People are making a statement about what they see the market doing. Flight to quality is an argument that some would probably say at this point. I guess that was the big point that I thought of with the title of the stream, the full business cycle. This whole space was decimated, and it's leaving a lot of opportunities. Now, I put out a couple of tweets, and one of them, maybe it'll give you some additional clarity on how to inspect opportunity. There's nothing to fade about a breakout. So we're seeing that across the board. Higher lows, just I showed you with Concentrator. Market cap and appreciation expectations. Now, the reason I allocated to the Concentrator is whole F of X narrative, Cleaver, whole Aladdin. They really do a bit of attention considering they've been working a fair amount of time on these products, and they haven't gotten a lot of attention. And the market cap just was like, holy crap. And total amount of supply locked is over 70%, so it's fully emitted. So fully diluted is going to remain more or less comparable to market cap, particularly because there's going to be no more dilution. So the market cap is the market cap. You could almost neglect fully diluted, particularly because it's all locked. So you're literally inspecting $1.5 million asset that has $14+ million in deposits. And if even from a traditional business evaluation perspective, it's like, oh my God. And from a technical perspective, it's very representative, maybe better representative than a lot of other assets. A full irrational exuberance, full liquidation, complete elimination of anyone, visitors, and then entrance, rational allocation at a very depreciated price compared to top. So it was a very compelling chart. So there's nothing to fade about a breakout other than market cap as it pertains to appreciation expectations. What are your expectations? So if you have like, let's show some comps. Not really comps, but let's show some comparison. This is a good one. FTM. 1.6 mil in liquidity, but it's a hell of a market cap asset. So great. Look, you have your irrational exuberance, full capitulation, full business cycle. Everything on Phantom is dead. Ghost chain, narratives done. Here's your rational allocation starting in 2023 after liquidity bottomed the Q4 2022. People said, oh, exit liquidity acquired, sold, sold, sold. And it went on for the entirety of the year, sold, sold, sold. Rational allocation. Trend break to the upside. Excuse me. Phantom is a $670 million market cap asset. A 10x puts it at $6.7 billion. And clearly 100x and you're pulling a BNB and you're at $60 billion. And now you know what kind of activity on this network is. What is Binance? Binance Smart Chain's crazy. The activity is huge. So Phantom clearly has been decimated from a network perspective. So from a comp perspective, which is something common talked about from a real estate perspective, it's not comparable. So I don't see any path to 100x. And in any way, for $600 million asset to go to $60 billion, you're talking about a restructuring of the entire space and like a significant attention being paid to this market. I don't think those are reasonable expectations in short time frames for such a high market cap asset. Albeit it does happen, and that's where the big money's made. But and the big money you want to make with small allocations, not with large allocations. But all right, so then a small allocation never hurts, 0.5%, 1%. But how do you compare that kind of expectation? All of a sudden, Phantom significantly comes on the radar as compared to how many countless other narratives are we talking about? What are the relative odds of that occurrence? So are your expectations reasonable? And you can only have so many 0.5%, 1% bets. You want concentration to keep your capital safe. So 40% positions, 50% positions, and your 10s and your 20s and your 30s, however you structure the portfolio, you want high concentration in the stuff that is more predictable, that you assign more confidence to with regard to why is it in your portfolio. You certainly don't want to allocate remotely the majority of your portfolio to something that isn't established, that doesn't have an established narrative, that doesn't have something that you could clearly talk about for 10 minutes and why it's never going to go below this price again. A floor, because that's your protection. That's what protects the value of your capital. So that's where the vast majority of your capital goes. And unfortunately, because of the crypto markets, those types of allocations are going to appreciate significantly as well. Chasing those 100x's, I don't think is, it's for me, something that's very small parts of the portfolio. I don't chase 100x's with large parts of the portfolio. Although 2030, 2034, whole portfolio will go 100x. That's this type of market. But then again, when you're talking about a $1 million market cap asset, that's when you get 1,000x on the money. The smaller the market cap, but the smaller the market cap is greater the risk. So how do you identify small, ultra small market cap assets that are considerable allocations? Clearly, we're not talking about shitcoins here. We're not talking about narrative absent assets that are just social media and vaporware. They're just a token, which is nothing. We're talking about enterprise here, cash flow, yield. And that's what stuff like Concentrator offers. So those are the types of characteristics. So I guess the best thing I could say is that those types of characteristics help me identify the few. And there's very few assets that I'm like, I could take a 1-2% punt and it could change the entire composition of the portfolio. And there's reason for it to. It makes sense for it to occur to go up rather than down. Anywho, just speaking out loud. Hope that helps a little bit. Dan's in the house. Tapsy, a pleasure. Will, DeFi Futurist, much a pleasure. Can you please talk about Aladdin? Well, yeah, I think we hit that very nicely. I won't have it up on the screen. Now, of the Aladdin ecosystem, I think Concentrator offers the best opportunity from a market cap perspective, fully diluted perspective. Cleve is still emitting, although it's a million market cap, 13 mil fully diluted. Shares similar technical attributes as compared to the Concentrator, as although it did produce a lower low. So my sentiment and why Concentrator is what I thought about was particularly because Cleve uses Concentrator, and it just tacks on additional incentives, which is why it has more activity. And I'm not a person to be swayed by activity. I'm a person to peer through the activity and see what the fundamental base layer is. And maybe that's my base layer maxing sentiment coming out, where I'm like, all right, great. What's it based on? What underlying infrastructure is it using? And you could clearly see, just in 5 seconds, that Cleaver uses Concentrator. And Cleaver is relatively light, 10 mil total locked, whereas Concentrator is not light. There's a lot of LPs, and there's a lot of capital, and there's a lot of yield to be had. With a total, if I refresh, total 14.8 mil, total value 46, 60 mil? Did I read all this wrong? TVO and Harvesters, total value locked. I was looking at the compounders. There's 60 mil deposit in Concentrator. Holy shit. Holy shit. That's crazy. So F of X, it's a big deal. It's got a lot of traction. High opinion of what they're doing. And my sentiment is this is why are folks attracted to this? Why is this doing what it's doing? Because it's offering products and services that are attractive. But what this is causing folks to miss what all of this is based around, and why what they built as like the first product, the Concentrator, why did they build that? And that is what Cleaver uses, and that is what F of X and their stables will use when you could borrow against like a variety of Concentrator assets at some point, theoretically, but that would make sense. An auto compounding liquid stake derivative that you could extract dollar liabilities from, 20% return on ACRV, and you're paying 5% interest or whatever. I wouldn't expect them to do, like a llama, CRV USD, which has variable rates, and some of them are up to 10-20%. Most interest rates, it only gets up to above 10% on Aave in crazy times, but point being, most interest rates are lower than 20%. So if you got a 20% return on your collateral and you're borrowing at less than 20%, that's a carry trade, and you got basically free liquidity. So I think that could be a hell of a catalyst. And sure, you'll see what happens from an FXM perspective, and you've already got a 10x. And this is the premium versus discount type argument. This is the last thing I would ever buy. It's already run, and And that's interesting for me to say because it's a 5 mil market cap asset. It's a micro, minuscule cap asset. Has emissions. Fully diluted is much higher. So a 10x from here, a 50 mil market cap puts you at $1 billion fully diluted. It it does is to me when I see things like this, it's not that it's bad. It's not it's a bad. Clearly, been a good opportunity for many persons that have it at $14, $15. None of this screams bad. So when I see things like this, I'm like, all right, there's something better. From a market cap to fully diluted inspection, and something that's more fundamental. There's something better. That's my perspective. So, I've never really talked about Aladdin. I tend to restrain from talking about teams and protocols and assets, but this happened to be a very good example for this time in the market of things that I see in charts and narratives that are meaningful, that could hopefully give folks some context into other assets, protocols, enterprise opportunities that are scattered everywhere in these markets. So premium versus discount and expectations are everything. If your expectation is for Phantom to go to the number 5 and go 100x on the money from here, that's like front page news. And frankly, what is it, supersonic or whatever Andre's the terminology is for their upgrade? Great, that's a big deal. It's systemically important. How many other chains are there? I mean, you got the super crazy stuff they're doing on Solana, and there's 1,000 other chains at this point that are all trying to do something crazy. So the expectation, fine, maybe you say it gets to a higher market cap, goes 100x on the money. But I invalidate it because I'm like, yeah, it's not unique enough. I don't have enough capital to own this, and this. So how do I invalidate things? I invalidate it because it's just a chain. And that's not the most significant thing. You need to look for reasons to invalidate opportunities, particularly because you're going to find way too many opportunities. And that is the norm. The norm is the vast majority have excess diversification and ineffective concentration. Concentrator. What? I hope that helps. I think that's offers some clarity there. And I think the curve narrative, as much as what is the curve narrative beaten to death? Is it something that it's like, oh no, all he does is talk about curve, and it's been like this for years. But there's a reason for that. It's not just that's my alignment. It's not that that's what I've put my vested interest in. It's that is what stands out, and that may be one of the few things that really stand out in this emerging market, particularly with regard to its capacity to print endogenous capital, endogenous liabilities. And that's ultimately what we all want to find is the most meaningful thing. So in good part, this is my stream, so I talk about the things that I see as the most meaningful things. Hope that helps. Hope that helps. DeFi Futurist. One Curious View, good morning. Cap, do you see we are taking off from here as Bitcoin surpasses $38,000, dip below again? Nope. Holy shit. Holy shit. Wow. All right. Well, talk about things saying things. Listen, gold punches a fresh all-time high. You're going to see some serious shit on social media. That's going to be fun. It's always fun when gold punches an all-time high and Peter Schiff starts to hit those tweets. I love it. I love it. Gold is important. Look at Bitcoin go. Now, normally a rising wedge often indicates trend reversal. It falls down. It's losing breath to the upside. But Could this be like a pennant, a rising pennant? It's not really a pennant because there's no flagpole. Peter Brandt has talked about this from a bullish perspective. This is a pennant and it breaks to the upside. Now, I guess what's most significant about a rising wedge is just where it breaks. Does it break to the upside or break to the downside? And frankly, it has just broken to the upside. And that is a clear trend line. 2 touch points right at the top. You could even drop this down a little smidgen. That is a clear trend break to the upside. And that's going on right now because this morning it wasn't there. 38,000, 39,000. And this is where the FOMO and the fever comes in. It's very different this time. It's not just 2024 that's very different. It's literally different right now. And while I always say there's a great likelihood for things breaking and liquidity disruption in traditional financials, what's always interesting and always in the back of my mind is that no matter how bad things are, there's always a tremendous amount of capital. Now, it might get sidetracked and be needed for other things. And that's the biggest thing that depreciates markets, for selling where the capital is needed elsewhere. But if a narrative is strong enough, in theory, it could pierce through everything. And that might be the case. And that's certainly something I wouldn't hang my hat on, but I wouldn't want to not have exposure in those kinds of conditions. And I'm willing to pay that premium. Sure, liquidity breaks in traditional financials and Bitcoin dips. Okay, where the hell is it going to dip to? All right, maybe it dips to this trend structure and you get a 30,000. You're talking about small percents. You're talking about 20% in crypto terms, whatever. Meaning that's not an invalidation of this directionality. Clearly, that's not an invalidation of where we're heading into 2024. So this is the time, more so than ever, for literally the way my portfolio is constructed. Just it is what it is. You want the exposure to this type of asset in these kinds of market conditions, because if all goes well, it goes up. If all goes bad, it goes down and then goes up. The destination doesn't change. The path may change. So, all right, great. You get a 10 to 20% dip. I find that it's an entire conversation to be had for new entrants into the space. But in theory, that dip was, 2020. That's probably one of the most important things that I offer to everyone is talking about the weekly and the monthly will drive you nuts. You got to talk about the 3-month and the 6-month. And these are the time periods that matter in the grand scheme. And it kind of gets interesting because it marginalizes entire lifespans. What the hell is 100 years? So I'm most interested in where like the next decade or two are going nowadays. And I think in context of where we've come from in the 50s, the 70s, and then everything changed post-2000. Then really changed in 2008. Then really changed in 2020. And then shit's going to get crazy in 2024. Did you know in 2024, $10.8 trillion of U.S. bills, bonds, treasuries need to be refinanced? Do you know how much paper came off the Treasury printer in 2020? Coincidentally, 10.8 trillion. So I find that quite interesting. Now, it's money. Treasuries are money. They're a money equivalent. I think the setup is fantastic for 2024. I've never seen anything like it. Just like I've never seen these assets, these companies. I've never seen anything like this in traditional financials, which is why we're here in the first place. Hope that helps. Adri's in the house, a pleasure. Joel, pleasure. Diego, hi boss. Can you tell us a little bit about your story and now you reach your actual situation? I won't bore you guys, but I have no idea how I got to where I am mentally, career-wise, I guess. The path, in hindsight, the path was weird and it was hard. It was a 2018, 2019, my father died, my grandmother died, and I had to take my mother from New York to my home here in Florida. And when I went to New York to get mom, I uh, I had two contracts. I was working two jobs. I was literally fired from both of them that Friday, on a Friday. So all of that family shit, double fired. I was out of work, and that was probably the most intense career situation I've ever had. Now, before I moved to Florida, I was working at Huffington Post, and I was laid off. That wasn't like it wasn't it wasn't a bad layoff. None of my layoffs have ever been bad. I'm overly qualified. Um, I was like Yahoo Oath merger. I don't even remember. It was years ago, and they had to reduce staff. But then I took a job at Universal Studios for a year. That was definitely the most fun experience I've ever had. And I worked for Royal Caribbean and a bunch of other places and Microsoft. And I did a stint at Facebook, but there was just this contract that lasted not long at all. Um, I have no idea how I got to where I am. And then if I look back to when I was really young, I have no idea how I survived. So that's another story. Anywho, I was in Orlando living in an apartment right across from SeaWorld, and I had 13 1080 Ti's. It was so hot in that apartment. I had a $400 a month electric bill in a one bedroom micro apartment. Small apartment, not micro. The AC was running 24/7. It was 95 degrees outside with 13 1080 Ti's cranking out. You could literally bake bread if you put a pan of dough and yeast right next to it. That was that was fun. So I like command line, I like Linux, I like shells and stuff like that. I'm not a DevOps guy, but I could do a fair amount of DevOps if I needed to. Nowadays it's all Amazon. So I'm I no one not many people or companies run their own infrastructure, hardware, cron jobs, so on and so forth. They're all running this shit on Amazon, the cloud. Anyway, I don't want to bore you guys with that kind of backstory. Maybe 2020. Clearly, I didn't have the stories or the capacity to tell the stories that I do today. 2020 was 2019 is where I moved in a fair amount of capital. I think I moved in maybe like 100 chip. No idea what to expect in 2020. And it just got wild, and folks didn't know what the hell was going on. Yield, interest, what the hell is this? Oh my God, Olympus days and Wonderland. Jesus, that's insane in hindsight. And I probably didn't have we even start to have this rigorous story about emerging markets and curve federation and organization of actors and just this recycling, sterilization, and understanding of traditional financials, collateral, liabilities, base money, actual paper currency versus bank deposits and bank money, and so on and so forth, exogenous liquidity, endogenous currency printing, and how the general public has printed over $1 trillion in the United States. Printed. So in college I was known for seeing the correlation, the connection, or being able to model. I guess that's probably the best thing to say. put something in terms of something else because I saw the similarities. So in turn, I saw what was going on in crypto markets and then started to realize this is the way traditional financials work, and frankly, it's the same exact thing. And then I was like, oh, it's not the same thing. It's like traditional financials plus plus because you have the whole mutability concept, deterministic concept, the decentralization conversation, separation of money estate and stuff like that. I appreciate all the narratives of Bitcoin maximalists. I think they're off base because they don't understand credit and how even deterministic monetary policy that does nothing for credit. Like if you replace the dollar with Bitcoin, it'll actually make status quo global financials even more dangerous because there's no way to deleverage the credit markets. The only way to deleverage the credit markets is to ramp M0. That's what they did in 2020, arguably because of the need to deleverage the system, de-risk the system. So I learned this stuff, I guess, out of necessity to understand these crypto markets to explore the best opportunities possible. Hope that helps. Good question, Diego. I appreciate it. I don't talk about my history much. Drew Poland, what's the dog doing? Which dog? My man. Oh. Yeah, that's I don't know, that dog's doing something. He's horse riding apparently, according to the tweet. That's actually fascinating. How the hell did he get up there? Oh my God. And that's two boys, by the way. Jesus Christ. And the boy at the bottom is liking it seems. That's when I pulled my screen over a little earlier in the stream. Dad, at what point do you trim winners to protect capital after being run if nothing has changed with the original investment thesis? Depends on the compartment of the portfolio. Investments, you have to size accordingly because investments aren't for selling, which is why I appreciate permalock concept. Because permalock is put a black piece of paper over 2024 to 2029 and 2030. You skip over it. You're at 2030. And the market is going to be quite fascinating in 2030. You can imagine the amount of liquidity that'll be in the system to keep this paper mache machine, the fiat system running. So that's long term. So you want to size it accordingly. So if you excessively size your investment compartment of the portfolio, then it gets into complexity with the money side of the portfolio. That's what you do with Bitcoin and Ethereum, or if you have Solana or anything liquid, LP positions, or pick any of the other chains, AVAX or Arbitrum or Optimism or whatever. The list goes on and on. That's the cash part of the portfolio. You trim based on knowing where we are in the liquidity cycle, so you have to certainly have to inspect. We're not even at the point where we can try and find top. We have to get through 2024 and $10.8 plus trillion worth of U.S. Treasury issuance, and the effect that's going to have on the composition of global liquidity. It's really the Mike Howell inspection. Top is where the Fed is like, oh, we might have to hike rates, and we have to trim the balance sheet, and they want to slow the economy. But we're not even at the point where they're trying to amplify the economy yet. So cycles will cycle. They'll have to try and pull us out of the deflationary spiral because they're going to need to ramp tax receipts to finance debt interest payments, as well as fiscal spending. They're just going to have to ramp tax receipts. This is what they're going to have to do. They need the GDP numbers. It's a completely artificial liquidity system centered around, it's literally like what China did for like 20, 30 years with their ridiculously high GDP levels. It was all, adjustment of the denominator, as Raoul would talk about, nominal versus real. But nominal does a lot. Nominal will rebuild a country. Go figure. Um, so I don't even think we're at the point of that conversation to assess like evacuation of the vast majority of the cash position in the stable coins. Investments are separate and apart. You're not liquidating investments. That's why it's so critical to assess investments for what they need to be. An investment is something you don't sell unless the narrative is invalidated. And the beauty of immutability and determinism is it's going to exist in the future. It is the most risk reduced investment I've ever seen. It's going to exist in the future. It cannot be if it's invalidated. One, there's nothing you can do about it because it's locked. So it alleviates you of the burden of, do I liquidate? Is it going to all roll over? The lock forces you to size accordingly. It is guaranteed to exist in the future. That's crazy. It changes the whole investment equation. And that is what is so appreciated about it. It simplifies it. So how do you accommodate those nuances? You have to size accordingly. I look forward to the conversation of that when we can talk about when's top. But we'll see it in many places. We'll see the bond market start to get agitated. We'll see price volatility because we're literally looking right now for Move to get crushed. When Move gets crushed, the dollar rolls over, and that's the whole thing we've been discussing. We're not at bottom yet. Move hasn't rolled over. The 10.8 trill hasn't been pushed out of Treasury yet. Can Move roll over? There's plenty of potential for elevated volatility and muted liquidity conditions in 2024. The system will be flush with collateral, but with the elevated volatility, it might not print as much excess liquidity as it did in 2020, even though it's the same amount of collateral. That's going to flood the system. So you might not see those highs that folks are expecting in the Bitcoin and Ethereum price. But maybe it is, which means you want to see. You pay a premium to see what this shit is going to do, because under almost every analysis, it's going to do something, and it's going to do something interesting. It's going to do something very volatile. So you pay a premium to be exposed to it. And it's exactly, look at this market. I told you guys for 2 years, you pay a premium to buy Pico bottom. There's only one way to buy Pico bottom, is to be in at Pico bottom. And have you seen these bounces at Pico bottom? If anyone who had a relatively decent sized portfolio at Pico bottom, your portfolio is up 50%. Not a position, the whole portfolio. And that's cool. So sure, it has depreciated from the highs. But this is just as much about the experience to understand the way these markets work as it is about just a higher number. And this brings us back to like the way I talk about measuring success. All-time high means jack shit. It's all fake money. It's all fake nominal, change the denominator money. What matters is time horizons and time frames and being right over time frames. If you're up from 2019, you're right. You were right. You bought things that were right. You didn't capitalize as much as you could, but capitalization, excess capitalization, is not the measure of success. If you were right, you were right. Period. Hope that helps. How does the Capstone portfolio look right about now? Basically, the best way to talk about my portfolio is throughout 2022 and thus far in 2023, I've taken 4 positions and I fell ass first into the 5th one. I was literally a micro allocation to the Nolo, and it's literally like 0.2% of the portfolio. It was higher. I mean, NOAA when it came over to Maine, that thing was up at like 1%. It was it was that was serious appreciation coming over from Solana. So I fell into that one. I'm just going to sit on it. It's a small part of the portfolio. Was in 22 we took the Aura. Early 23 we took the Convex, Prisma Airdrop, which was done in a very tax-friendly way. A little bit of added to Prisma, and thus far just the Prisma LP that's literally printing like 500%. I don't know. I was in it when it was like 1800%. So that added, basically a couple thousand to the Prisma position. I have no intention right now of retaining the LP position for an excessive amount of time. I mean, as long as it's still over 100%, I'll retain it. But that gets liquidated. That's a liquid position. That's a cash position. And that's not right now, I would say, earmarked for allocation to anything. That gets liquidated to like base Bitcoin, Ethereum, stables. Concentrator, CTR, that's it. And CTR is a micro allocation, sizing of the position, 1%. 1% to 10% changes anything, everything. And frankly, I don't think it does 1%. I'm quite excited to see what it does. It's at bottom. It's literally at bottom. And literally $500 moves move at pennies, move at percent. A couple $1,000 moves at percents. It's just some, it's hard to talk about assets because if any of you guys right now buy any of this, it goes up in price. So it's a very complicated topic to talk about assets because then everyone becomes a vested actor. Then if anyone sells, it affects everyone that is hearing the conversation, and it just gets morally confusing for all parties that have taken action. My intention is probably liquidation after significant appreciation, or maybe not. Frankly, the returns, interestingly enough, the returns are from very productive assets. Productive assets that are producing 20%. So listen, it goes 100x on the money, which would be crazy, and it'd be $100 million market cap asset, which is still like micro cap in TradFi terms, and it's producing 20%. I'm the type of guy that I'll take the 20%. I'm the guy who wins the lottery and takes it over 50 years. And then these dum-dums out there take lump sum, pay half of it in taxes, and then blow it all. I'm the guy who takes it, $1 billion. Oh my God, he could literally take like $20 million a year. That's what makes sense to me. I cannot process any other way to engage with that kind of experience. Hope that helps. Hope that helps. Base chain ecosystem updates. That's literally it. I have seen these bottoms across all these charts. I mean, Joe looks great. A lot of shit on Arbitrum looks great, and nothing stands out from like, oh yeah, that's crazy. And I'm sure you can make multiples. The problem is I don't have that kind of capital. It's not 2020. I mean, literally, if you put $1 million into something that goes up 50%, you just made $500,000. And in these crypto markets, you do that in a week. So I don't have that kind of size, and that's the kind of opportunity you could take with larger market cap assets. To put $1 million into an asset, it probably needs to be $500 million, $1 billion market cap. Otherwise, you're going to move the market. And when you move the market, it's relatively illiquid and it's difficult to exit. And that's why you see literally rug pulls, it just drops, or it goes down 50% in a single sell. And that's by definition in a liquid market. And that's not something you want to engage in necessarily from a risk-adjusted perspective with size. You don't want to be the destroyer of markets necessarily. Some like it. But you do that with depth, and it's much easier to execute the behaviorally like that when there's a fully liquid market for the asset. Hope that helps. And one, play five. Take a look at Ola's chart. AI agents, Valor Labs. Sounds like no. Thank you. I appreciate it, but I'm not interested in just the narrative of AI. My investment thesis is the concept of money. Therefore, this is exactly what DeFi Futurist is asking. Can you please share your knowledge on how to be a crypto expert? My thesis on investments is what is money? What makes money meaningful? And what causes behavior, incentives? And what is the foundation of economics, credit, the borrowing of money to engage in activity, growth activity, productive activity, speculative activity? So AI doesn't interest me much from an investment standpoint at all. I hope that helps. So maybe to elaborate, crypto expert, money. You have to understand money. You have to understand collateral. You have to understand the U.S. bond market. You have to understand when you'll be an expert when you see Powell speak and Yellen speak and you hear their words, but you're like, oh, this is why they're saying what they're saying. This is what they're doing. This is why they're doing what they're doing because of these conditions in the system. Like, let's take a look at the yen. Look at that, 147. So look at that technical setup for the yen, 200 SMA in the 3-month. It needs to come down. What this chart screams is they need to trigger the cycle. They need to get capital flowing back into Japan. Why? Because of the systemic importance of it to the U.S. bond market, treasuries, what they have in their piggy bank, because treasuries are foreign sovereign savings accounts. They use it when they need to spend dollars, because they don't make money in dollars, they make money in yen. So they need to buy dollars, and when they buy dollars, the dollar goes through the roof. And when the dollar goes through the roof, the whole system falls apart. So the dollar, when they're screaming, no one sees a recession. It's because of the GDP situation, the amount of fiscal they've spent. GDP has been strongly elevated. Interest rates have suppressed domestic credit, frozen U.S. domestic credit, has completely frozen U.S. real estate. And they say no. Why would they say no recession? Because of the fiscal, obviously. But what if the dollar rolls over? The dollar rolls over, foreign fiat increases purchasing power, and commercial real estate, let's say it falls apart. Everything gets sold for pennies on the dollar. But all this foreign fiat now has purchasing power. What if they could buy? Frankly, that's what's been going on since the 70s. Foreigners have been buying U.S. assets. What is it? The net NIIP, net investment position, net international investment position. That's what Luke Roman always talks about. Of foreign nations is a huge number. They just own a huge amount of U.S. assets because of these types of cycles. Because when things break in the U.S., foreign fiat coincidentally has increased purchasing power because cyclically the dollar is massaged to roll over, and they could swoop in and buy assets on a discount. And cyclically, this all makes sense. So we want to see move roll over, oil fall through. It's been expressing some support. Gas prices lead oil. And we want to see the dollar roll over. Anyway, that's what it means to be money expert, is to understand the causality, the cause and effect of all this shit that ultimately triggers increases in liquidity and the appreciation of these assets speculatively, but then there's the investment appreciation. Investment appreciation is very different than exuberant appreciation of the cash position, how you get capitalized there. So investment appreciation is more so like, why are these systems significant from a global financial perspective? These credit systems, because the whole fucking financial system literally is credit. 99%, some very high number, of dollars on the planet is credit. It's all credit. There's very few. There's only $5.56 trillion on the planet. What was it? Mike Howell talked about like 170, 190 trillion dollars in global liquidity, dollar liquidity. And even USM2 is $20 trillion. But underneath it all, there's only $5.5 trillion bills, like the actual dollars on the planet. Everything else is a synthetic dollar. And that is exactly what we're dealing with in these crypto markets. The capacity to extend credit prints a dollar, and that dollar enters circulation, and it has a capacity to do exactly what a dollar does. That's why these investments are interesting from a 2030 perspective. Hope that helps. Oh, you guys are going today. Let's keep it going. Glad to be back in the team. Discord, I asked if you could explain step by step, a simple way to start using DeFi with Curve Aave. Eventually, if it doesn't bother the most experimented. Adri, Starburst, if I'm correct. Experiment. I mean, Aave is a good just a place, but it's very expensive. I mean, literally got 93 Gwei right now. It's probably gonna be like $50, could be even more. I've done like $80 transactions over the last week. It's expensive on mainnet, so you're probably gonna want to play around in like an Arbitrum, Polygon, or Optimism. Polygon should be fun. Their POS, you don't have to do their ZK implementation, Polygon POS. We had a lot of fun with Aave on Polygon POS. Dan will remember that one. Did a lot of cash and carries for a bit over there. But it's not like that's opportunity. There's no opportunity just depositing collateral into Aave and borrowing USDC. But that's a meaningful experience to know that you can borrow cash using collateral. So the whole conversation we have at this point is understanding what those things are. What is cash? What is collateral? And that's everything we talk about. Just those systems unto themselves are nothing more than engaging with those systems unto themselves would be nothing more than understanding the buttons to click to do different things. And that's meaningful, so I could appreciate that. Curve is going to be very expensive on mainnet. And that's probably a great place to click buttons. It's literally just like an Aave on not mainnet. I think that's the best way to probably say it right about now. I mean, Solana is probably a fun playground. I don't really play over there, although we have our allocation to Hero Network, which is like, why own Solana? If Solana does what it's going to continue to do, and there's $6 billion volume of trading on Solana, which is like record high, then that's my thesis for Solana, thus my allocation. But Solana is a great place to play, but you're not going to get your mainstream protocols. It's not an EVM network, so you don't have your Curve, you don't have your Aave, and you don't have your primary bridges like Stargate or what have you. You're going through other names which are big. Synapse just added support, I think. I posted in the L2 channel on our Discord some of the bridges that go over to Solana, including the old traditional wormhole, which I didn't put in there, but that's effective as well. But Solana is a good playground. but just be meaningful. Be mindful of that playground. It's important to know the buttons to click. It's a whole different conversation and process to construct a portfolio of investments, construct a portfolio of cash from an FX perspective where you're swapping back and forth between denominations. A whole different conversation. But they're not mutually exclusive. It's independent, meaning you can play around, but just understand that you probably want to, at some point, unwind everything and go back to cash. And if your cash is less than what you started with, that's okay. Just you don't want to lose all your money, so you have to be careful. But that's a premium, which means you paid. You paid for an experience to click buttons, to see what things do. And I can never say that that's not meaningful. That's obviously a rational thing to do. I hope that helps. It's a long road. We've been doing this for years. So, allocate $100. And on Polygon, you're going to be able to gain a fair amount of experience and click a lot of buttons to see what a lot of things do and why they do what they do. And I'm sure everyone on Discord likes to talk about the good old days and what to play with. So that's always something to inquire about. So that sounds reasonable to me. I hope that helps. Um, where am I up? Where am I up to? DeFi futurist Captain. What are the scenarios in which crypto could be killed? Killed. Finality. In conclusion. End of the road. Sun flare. Reversal of the magnetic field of the planet. Premature red giant. Sun turning into a red giant. These are types of things that would kill crypto. But otherwise, with governments, this has nothing to do with the U.S. They keep. That's why it's so awkward when they say they're going to regulate DeFi. In which country? On what network? Which protocol? Is the protocol a company? Is the protocol a person? Where is the protocol? Can you even say where is the protocol? It's kind of like it's in cyberspace. The blockchain is kind of like the cloud concept. It's everywhere, yet nowhere. They're not prepared to answer these kinds of questions. And that's kind of why they've attacked these relatively strange named protocols that are small. And, I don't mean to knock on these protocols that have been attacked by them. But they were attacked by them because they were low-hanging fruit. They were small, and they had some sort of centralized actor that could be held accountable. And this is why that conversation of achieving decentralization, I guess, is a conversation. What does it mean to achieve diversity? What does it mean to achieve effective decentralization if you started centralized? And this is like Caitlin Long talks about stuff like this, or maybe she does, but it's like a grace period. You got 2 years to get critically decentralized. So these are the types of things that are going through Congress and the minds of legislators and on how to proceed with stuff like this. There's no precedence for the inception of enterprise like this. I mean, literally all of traditional finance is about IPO and just registering and trust. And that's the whole point of regulation is to attempt to establish trust. So, but that occurs at a different way in these markets. Trust is an organic process. It's built over time. Lendiness. That's not something that's the case with just traditional finance. Traditional finance is you better prove you're trustworthy up front. It's just a whole different world, and it seems so archaic and just octogenarian. It's like, all right, great. This is what they thought of 100 fucking years ago. Whoopie fucking do. Good for you. Keep doing your shit in equities. And there's got to be a better way. So I think this organic concept of trust is clearly that's the way the markets traditionally were, like 1,000 billion years ago. It's kind of like got to go back to grassroots, and that's why maybe the space is so appealing. That's why it attracts so many. What if BTC was created by the government to get us all on CBDCs? CBDCs aren't what people think they are. These economics of the United States and foreign governments aren't what they think they are. Money isn't what people think it is. Economics aren't what people think they are. These are systems of control and rationing. Or money is a means of coordinating a productive population, maintaining civil order, incentivizing behavior, and rationing natural resources. I did a post about that like forever ago at this point, but that's someone put that in like a tweet or something. Quote that. It's a good one. Rationing natural resources. Money is a tool, and it's not the tool you think it is. So I'm a very contrarian in many regards. Like I'm a fan of money printing. I just know that the human is the problem. Humans are the problem. The subjectivity is the problem. Like a deflationary money supply is an absolute disaster for a global economy. A disinflationary money supply is a disaster for a global economy. You need an elastic money supply, and it kind of needs to be on a commodity by commodity basis. You see, that's the only way to manage consumer price inflation. You need to inflate the money supply for a particular commodity in order to prevent prices from going down. You need to contract money supply in order to prevent the prices from going up on a commodity by commodity basis. I know that's a bit of a loaded statement. That's a conversation unto itself about like how I could see more of a Keynesian economics working in a better way. That's not the way the system works. But they try to do that, and they frickin' suck at it. But it's the only way they could build a system in the 1900s. They didn't have that kind of granularity. It was a fucking analog world. But now there's a digital world with concepts of immutability and concepts of determinism, and that changes everything. So I really think the solution to economics is Keynesian. You're literally mutating the money supply depending on conditions. And the problem is humans. And if you make it predictable and determinable, where you know under these conditions this is what's going to occur, then that's what cures the malinvestment. That's what cures the speculation. Everyone fucking betting, is the Fed funds rate going to go up? Because humans are making the choice. But if it was a piece of software that says if these economic conditions, these specific numbers are like this, the policy rate goes up. There's no betting. I hate that shit. I hate human subjectivity. I love the comfort of determinism. Anywho, that's a bit of a digression, but it's you. You brought up CBDCs. So it's all about control. They want a capacity to control the population. It's not necessarily a bad thing. It can turn into a horrible thing. But you still need a way to coordinate the general public because the general public doesn't understand these concepts, unfortunately. And that's why in history we have all the experiences we do of social unrest, social instability. It's a mess. You can only imagine where things may be in in the future with technology and technology applied to economics, and it could be much better. Especially that's the nature of iteration. You try shit, it fails, you make something better. The problem is when something fails in meat space, it tends to be very bloody. Rupert, prefer this stream to the combined one. Thanks for your service. Mondays and Fridays, I'll keep doing this. I like this content as well. But I love talking with Ben. I love talking global macro. And I'm very much a fan of what he does with Tapioca. And he has great insight into the way this system works. So It's all good. All of this will continue, and I'll try and get on Leviathan as best possible, but time isn't always available. I choose Wombo. BRB putting on my 10th tinfoil hat layer. Might miss the rest of the stream. Mama, I mean, it's a good conversation. It's a lot. And but it's good to understand the nuances of that conversation because they impact things that are meaningful. Uh, Put a link for permalock in chat. Well, there's no permalock. It's the concept. It's the concept of locking assets. This has really started with Michael and Curve with the tokenomics, and back in 2021, I said a narrative like Curve, the tokenomics would be everywhere. I kind of didn't think that was going to occur for a while, but holy jeebers. Sure, the tokenomics kind of went everywhere. Hot damn. So I guess what you guys remember that? That was the 2022 narratives, or maybe even the 2021 narratives. I had that as a pinned tweet for a while. I wish there was like a previous pinned tweets feature so I could easily find some shit in Twitter, in X, but it's not so easy to find stuff sometimes. Sir Joe present and accounted for. Sir, yes, sir. Aiden's in the house. Shabbat, shalom, absolutely. Yes, indeedy. Yes, indeedy. Cap, which one is the best for staking a ETH amount of Lido, Rocket Pool, and Kraken? Well, I'm not fond of the companies, the centralized exchanges. I don't know. I don't stake my Ethereum for frankly the same reason that Vitalik Buterin said. I want my money in my control. Interestingly enough, so I agree with him. Not that I have generally a bad sentiment to Lido or Frax or Rocket Pool. I just don't give a shit about 4 or 5%. You hold an asset for 30 minutes in the crypto markets and you're getting 4 or 5%. So yeah, clearly if you have like $20 million and you throw it in Ethereum and you get 4.5%, 5%, okay, cool. That's an investment thesis and how you would construct a portfolio. That's not the way I've constructed the portfolio. I don't have that kind of size. So it's just not on my radar from how I could even remotely approach structuring the portfolio. Food for thought. I'm looking forward to Frax Chain. That's interesting. And one play 5. My thesis is technology, all money is on data sets in tuples. Well, data's everything. AI is going to change the frickin' planet. Robotics, everything changes. I mean, literally, Biden said it. I retweeted a post earlier, and it was a very coherent, very clear statement he made to the Chilean president. Everything will be different in 3 years. I mean, he literally said that, and I'm like, did he really just say that? Everything is going to be fucking different in 3 years, like crazy different. Just 3 years. The amount that they have to refinance in 2024 is screaming the potential for this Eurodollar system that has emerged in crypto markets to literally change the composition of global financials. I mean, literally, doesn't this stuff invalidate banks? So banks are obviously of systemic importance to the sovereign because banks have been mandated by Basel 1, 2, 3, 4, 5 through 1,000 to sterilize excess U.S. government debt in the market. They've been mandated to buy the government debt such that the general public, literally getting a direct deposit, is financing U.S. fiscal spending. Oh, shit. So that's why it's so important to understand the way the current financial system works, because that's real. That's real. Literally, at this point, it's so shallow to say dollars in the bank aren't dollars. That's literally the tip of a damn iceberg. It's bank money. It's a bank liability. It's a dollar. The bank owes you a dollar, but you can make payment with that IOU. That bank owes you a dollar. You can pay people with it. How do I know? You pay your credit card with the bank owes you a dollar. Will the credit card accept it? Sure. Amex, the bank owes you $1. Cool, you can pay with that. So that's what this system is. I owe you $1 is equivalent to $1. And there's so many more I owe you $1 than dollars that the vast majority of dollars are I owe you $1. Let that shit sink in. Humans won't be main users in markets by 2030, 2040. Agents replace humans regardless. Well said. I agree with that statement. Agents are a big deal. AI, it's big. I mean, literally, like 20. You brought up a time horizon that I appreciate. If anyone appreciates it, I do. Customer service is done. 2030 to 2040. There's no humans in customer service. There's no humans in warehouses. Amazon showed us that with its literally like early robotics. Imagine 2030, 2040. There will be no humans in warehouses. Odds are homes won't be built by humans. You'll probably want like there's irreplaceable places for humans heading into the 2030, 2040. You know, like you want a human to you need the personality, you need to be personable. You want a human for like repairs and maintenance, but not like commercial grade, like residential repairs. A robot isn't going to drive to your fucking house and get out of a car and come into your house and do shit. No, that's a person. So there's still plenty of place for skilled labor for a human. But the whole composition of everything is going to change so radically, so soon, so fast. That's just everything that Raul talks about. It's just fantastic to think about. There will not be a single human in a fast food restaurant so soon. I mean, 10 years? Do you think there's going to be a human in a fast food restaurant? No, you're going to drive up to a relatively, maybe the same size McDonald's, and it's going to be you could be literally talking to a robot that looks exactly like a human, that talks exactly like a human, and it isn't a human, and a machine opens a door and you have your meal. And you sit down just as if it was a McDonald's, except there's no humans working at the McDonald's. Isn't that inevitable? Don't you see it? Don't we see it? Now, whether there's an investment there is another story. And I don't see the investments I like there. I'm sure as hell not going to buy some fucking equity stock in a company that an equity literally is by definition the company using me as a capital raise because they issue stock to raise capital. So you are literally a capital raise for a corporation. I don't buy it. I don't subscribe to the mainstream blue pill shit. Equities are gross because then you got a board, then you got a CEO, then you got human resources and real estate expenses. And no. At least from an investment perspective. That's why these crypto markets have got to be the best investment I've ever seen. No real estate, no board, no humans, pure software, dealing with money, banking, exposing to you banking infrastructure, the shit that the banks have kept you cannot access if you wanted to. HSBC, here's $1 million in dollars and $1 million in euros. Go make me a market, give me 0.4%. You can't do anything like this. This stuff is crazy. Hope that helps. Cap, do you mean to be a crypto expert? We have to first and foremost be an expert in macro and traditional finance. Absolutely. I do mean that. Because what are these investments in crypto business? What does crypto offer? Sure, there's data storage, and it's like the whole gaming narrative because you could store assets and NFTs and metadata, so on and so forth. So that's cool. Data storage. But from a money perspective, it's credit. It's credit. I'm sure you could have your like gambling and perpetual swap markets and stuff like that, and DEX software. So what What is it? What is the offering? What is the business? It's credit. That's it. I mean, that's literally the business. And people would say it's just credit, and then I would say it's just credit. Credit is money. That literally is how the world works. It's the currency the planet uses. They use credit, dollar liabilities, and that's what this is. So you absolutely have to understand what a dollar liability is. You have to understand the composition of global dollars. You have to understand how they're made, why they're made, the history back to the 1950s and the birth of the Eurodollar market and why it was born, why everything changed in 71, why they closed the gold redemption window, and what they're doing and how they're managing fiscal, and that, yeah, they spend too much. And there's a reason they spend too much, because politics is fucking crazy, and it's literally an exercise of financing civility, population civility. And clearly that has overtones of, you know, catering to one's self-interest from a politician perspective to get reelected. If you give someone money or a town money, then you're more likely to get reelected. And, oh, I'm fighting for you. I'm going to get this amount of money for this town, and we're going to rebuild this town. Yeah, you're going to get reelected. So, and then you realize it all reduces to incentives. People, the entire world, everything everyone does you could find an incentive everywhere. It's all incentives. Whether it's obvious or a subconscious incentive, it doesn't matter. There is an incentive behind everything. So psychology is critical to understand to be an expert in these markets too. Hope that helps. Dan, Aura. Relatively new asset. Obviously, I'm pulling up data on KuCoin. Technicals look good. Complete capitulation, higher low, break above moving averages on the daily. Definitely a break above, and then it fell below, but it found support clearly on the 200 SMA on the daily at least, and you can't really go out to the weekly or the monthly for this asset. But this looks good. This is not when you liquidate an asset. Surely not. I mean, literally, if it's just for technical reasons and overall cyclicality reasons of where we are with liquidity and 2024 conversation, this is not where you liquidate. So as of right now, I can comfortably say it's not even on my radar. Get that weekly cash. I mean, and the weekly cash will go up. And frankly, if the weekly cash goes up from here, maybe I'll never think about liquidating. It's like 800, 900 bucks a week I grab off this thing. That's cool. And that's not, I mean, maybe that is life changing for many folks. So who am I to make conclusions? So I certainly am in no position to complain about that number, and my wife always reminds me to remain humble, and I'm very appreciative for that number. So everything that I see right about now says I retained that position. Hope that helps. China will start printing in 2020. They've already started printing significantly. Their real estate is collapsing. And there's stuff literally going on today, and there's liquidations Monday potentially. Evergrande and whatever the hell the other one was. I forget. The bigger one. They have a catastrophe in the making in their real estate market, which was 25% of their economy. Everything about this system points to a flood of liquidity next year to maintain social order and finance civility of the populations. And that's global. And that means every country ends up aligning at some point, and they end up financing together. And that's the concept of like rate cuts and fiscal spending and stabilizing the economies. But it's all about social order. Hope that helps. Brian, love the collab on Wednesday. Thank you. I appreciate it. I like that opportunity. I think we're going to continue that on a weekly basis. Definitely a good time. Thank you very much, Cap. I appreciate you. And please know that you are very knowledgeable. Thank you. I hope I'm also humble. I try my best. It's been a long road to get to where we are with knowing the things we know, but it's an ever endless process figuring this stuff out. I hope it helps. This was a long stream. There was a lot of comments. I appreciate all of you. Thank you for making it to the end. It is Friday, December 1st. Enjoy the weekend. I'll be back on Monday and next Friday. 22 people made it to the end of the stream. 11 likes. We could do better. Please press that thumbs up button. Tell everyone to subscribe. In the description is a link to the most rational community in the entire crypto space. I appreciate everyone in there who survived together this bear market. I will see you guys again next week. Peace.